Well, welcome to Aspire. This is the last one of the fall season. We will not do another Aspire until probably February or March, and we're always looking out for speakers and trying to reach out and stuff. As most of you know, we will be celebrating 30 years next year, and the anniversary of the firm, and so it's been a fun trip, and we're expecting another 130 years, okay, and long after me. Simon and Mark and some of these guys are going to live to be 125, so they'll be able to do this for a long time. We want to remind you too, and you're going to hear some today about tax planning, financial type work at this end of the year, with whether it's forecasting, financial statements, compliance work with audits, reviews. We'd be delighted to talk to you and or your clients about that kind of work and help that we can provide, as well as tax planning and prep. We're really pushing that this time of year. It's one reason that you're hearing what you're hearing today from us. In addition, on the investment banking side, there is still so much capital and so much opportunity out there, whether you want to sell, whether you want to recap, whether you want to refinance, whatever it is, whether you just seek growth capital, there's plenty of that money out there. So let us know if we can brainstorm with you, friends, clients, whatever, about what people's needs are. But we're delighted to do that. Handouts today, you should have a CP evaluation form. We'd appreciate it if you fill that out for us and just return it to us. If you want the CPE credit, just make sure and turn that form back in, and we'll make sure that gets out to you. We also have an Aspire evaluation form, so we'd appreciate that. We've given us some feedback on our speaker today. There are going to be videos done of today's event and the speech and stuff, and put on the website. We break it down into smaller 15, 20-minute segments. You don't have to listen to the whole thing. You can look for pieces that you want to hear. If you want copies of what we're doing today, let us know. We'll be glad to provide that to you. Or we will send Mark out to speak to your group or to talk to your company in a larger group or a smaller group, or whatever you want to do in terms of the information stuff. We typically will highlight, some kind of nonprofit for those of you who've come before. But we thought this month one of the things was just to remind everybody there's still a huge need with regard to the tornadoes that swept across the whole city and pretty much the whole region. I think there were 11. They finally decided. Some of us who missed it by one block. Okay, I can just tell you it's scarier than, if you haven't been through a tornado, it's scarier than what you think it is. So, we know that North Texas Food Bank has reached out to us, the American Red Cross, Dallas ISD, Richardson ISD, the Salvation Army, Dallas Lutheran, and the Lutheran School. You can actually do care packages directly to DISD through Amazon. There's a great resource guide too that's in D Magazine, so we would suggest if that touches your heart and something you're interested in doing, there's plenty of need out there. There are folks that lost everything they had. And so we'll send you out some links this afternoon to connect you with that. Now I have a chance to introduce our speaker. Mark joined us a few years ago as the director of our tax services group. He's done a phenomenal job of stepping in there and really taking and pushing out information to clients and stuff. I actually believe that he has the code memorized, okay? And so feel free to test him today just to see what he knows and remembers. He's shaking his head already, going, I know he set me up for it. But he's going to talk today about live for today, but plan for tomorrow. And that is one of the things we really encourage our clients to do. Work with what they have today, but stop every now and then. And one of the things we really work for as a firm is in fourth quarter to make sure every one of our clients gets a phone call. Where are you? Do you know where you are? Do we need to talk? What do we need to do? The last thing that people want is surprises. And so we really try and work through that. So I'm delighted to introduce you to Mark today and let him take the floor and jump in.
Thank you everyone for coming. I'm going to try not to bore you. I know taxes can be one of the rough subjects, especially when things don't really change a lot. Last year we had the big tax reform. Unfortunately this year, with everything that's going on, our government really can't get anything moved forward, including things that had to do with the tax reform and finalizing things that happened. So my plan is to kind of just go through, talk about some normal year-end planning, things that we talk to our clients about, what they should be looking at, what they should be doing, run through some areas that we came across this past year that I think are interesting when it comes to taxes and thinking about how it may impact you going forward, and kind of going from there. So I kind of started off with a nice little quote: "The hardest thing in the world to understand is income tax." A famous person, Albert Einstein, said. It's right behind the one that there's always two things that are sure in life: death and taxes. These are the things that I'm going to be kind of talking about, things to consider, some business considerations, various individual considerations, such as the Section 199A, some withholding concepts. I'm going to touch upon qualified opportunity zones, spend a little bit of time there to kind of go brief overview of what it is, and kind of things that we've been seeing. Some updates in the planning for estate and gift tax, and then some other considerations to be thinking about. Starting in things to consider, if you were here last year, this is very similar to what we had discussed last year. These are kind of the things that you want to be thinking about as we're approaching the year end. One of the reasons we wanted to do it now at the beginning of November rather than later towards the end of the year is it gives you time to start to review your information. Whether from a business perspective, it's reviewing your financial statements, understanding, if you're on a cash basis, what are your expected collections, what are your expected expenses, to plan at the end of the year to maximize what your deductions are going to be and minimize your income, to save on taxes and kind of defer it into the next year. That could be accelerating or delaying income and deductions, such as anticipated bonuses, accruing them, or even paying them if you're on a cash basis. Capital asset purchases. If you have a large project that you're anticipating in the beginning of the first quarter, maybe acquiring all those assets up front, putting down payments down to put those on the books ahead of time to maximize the bonus depreciation on those assets, which helps bring down your taxable income. Sales of appreciated assets, understanding if you have a sale of appreciated assets, what the impact's going to be on your overall tax liability. Other things that we talk about on an individual's perspective is harvesting and selling long-term capital losses to offset any long-term capital gains that you may have. These are all typical, normal things that we have. Paying attention to what your passive income and passive losses are, so that we can match and make sure that you're not missing out on any of the passive losses in the year. One of the things I wanted to bring up, especially with everything that's happened, is taking a look back at this past year, looking at your tax returns, reviewing how did the tax reform impact you? Did you end up paying less taxes, or did all of the changes when they get your return, did they end up costing you more? There's a lot of things that have gone through in the tax reform that go up and down on your tax return, and without actually going back and looking at it, you may not know how it actually impacted you and how to plan for that and say, wait a second, did this really save me money, or was there something I could have done to take better benefit from the Tax Cuts and Jobs Act? Did I get all of my 199A, or was I limited? Was there something I could have done from a capital asset standpoint that would have helped me maximize my deduction? These are some things I'll talk about when I get into some of the other areas. Other things to consider about is, normal charitable gifting highly appreciated assets to take the benefit of the step up to, when you gift them. Reviewing your retirement contributions, carry forwards for planning opportunities, and other life cycle changes. These are all typically the normal things that you'd look at when you get into the year end and kind of plan as you go forward. So getting into some of the business concepts, one of the areas I wanted to talk about was the business interest limitation and the business and bonus depreciation, two topics that are pretty relevant when it comes to businesses, especially if you have larger businesses. Now, the business interest limitation only applies to businesses with gross receipts over $25 million. However, there is an aggregation rule, meaning that if you have businesses that are interrelated through ownership, you could have to aggregate all of those businesses together to look at it. We had a client that's in the real estate business that owns shopping centers. And even though one of the entities that held a shopping center didn't meet these qualifications, when we had to look at the rules, we actually had to take all of their entities and look at them in aggregate, and it ended up meaning that client ended up having a business interest limitation when you looked at it. So some of the things that we get into when we look at that is the interrelation to those rules on the business interest limitation against bonus depreciation. So the business interest limitation really looks at all of your interest expense. It takes your taxable income, adjusts it for interest income, depreciation, and some other items to determine whether or not you're actually allowed to deduct all of your interest expense. So once you take that adjusted taxable income, you multiply it by 30%, and that's the amount of interest expense you can take. So a lot of these entities that are highly leveraged, especially in the real estate business, can't take all of their business deductions. Currently, the rules do allow for a depreciation add back. So what that means is when we look at these bonus depreciation rules, if I'm taking 100% bonus depreciation, I can add that all back to my adjusted taxable income amount before I multiply it by 30%, which is extremely beneficial, when you're doing this. However, that rule about adding depreciation back ends in 2022. It starts to phase out. So you won't be able to look at that and say, what is my adjusted taxable income, and get that large add back. So things that we need to be starting to plan for is if you're relying on that depreciation add back to allow for this interest deduction, you need to start to consider deleveraging or restructuring in a way to move some of that debt off the balance sheet so that you're not being limited in your business and you're able to take the deductions that are there. Going into the bonus depreciation, right now it does allow for 100% depreciation. This gets back into thinking about capital asset purchases and looking to the end of the year and saying, we deal with a large janitorial business that gets into contracts really close to the beginning of the year. And we always talk to them about it is, look at what contracts you have coming. Go ahead, purchase all of those assets up front that you're going to need for that project, because you get to deduct it all in the year that you purchase it. And so it really helps to reduce their taxable income and plan. And then what we tell them is, next year, now we go into 2020 and keep looking forward, keep analyzing what's going on, where we're at, to continue to bring that down, because it is a timing impact. Once you take that deduction, you're not going to get the deduction next year. So you have to take that into consideration. But, like I have a large client in Fort Myers that almost got hit with the business interest limitation deduction. But because of this bonus depreciation and the depreciation add back, we're able to take the benefit of those rules to kind of force them out of a taxable income position that they would have been in otherwise. And going forward, when you start to get limited on your NOLs, it's a concept that you want to consider and make sure that you're aware of how this may impact you. Again, we talked about the interaction with the limitation on the bonus depreciation and the expiry. Now, there is a rule for certain real estate property trader businesses that allows them to elect out of this business interest limitation, even if they meet the qualifications. However, that means that you're required to use ADS rather than makers. What that means is you cannot take the benefit of bonus depreciation. And if you decide to do this, if your entity has already taken bonus depreciation or maker's depreciation, they'd have to go back and recalculate what the recapture would be on converting to ADS. So these are other considerations to think through. This concept, the excess business loss concept, is an individual concept that was added in the tax reform. So if you have on your individual return losses coming from businesses, whether it coming from flow-throughs or Schedule C, that are in excess of $500,000 for married filing jointly, $250,000 individually, those losses may be limited. And you may end up basically taking an NOL on your personal return. So these concepts are important to understand. If you're planning your individual return to utilize those losses against other income that you have, you need to understand how these rules interact and what they could mean going forward for you. Other business tax items to consider. I want to just refresh everybody on the 1231 exchange rules, where they eliminated tangible personal property from those rules, meaning that if you had a business where you were trading in your autos from year to year or periodically, where you could defer any gains on the trade-in value, that no longer applies. So if you actually have a trade-in that would kick off a gain, you would have to recognize that gain in the year that it occurs. Now, with the new rules regarding the bonus depreciation, typically if the new asset, the new automobile is over 6,000 pounds of gross weight vehicle rating, you can get the bonus depreciation on that and depreciate it all up front. But these are things to consider. If you're bringing in an auto that doesn't meet those qualifications, you may have a gain in that year that you have to consider. Corporate AMT credits, if you're not familiar with this, they removed corporate AMT, and if you had a AMT credit carrying forward from year to year that you hadn't been able to take yet, they allowed it to be refunded to you 50% each year over the next few years. So that may be available cash that you may have that you're not, you may not be thinking about, something that you're going to be getting coming back to you that you should consider. We had a variety of clients that had these, and I think one client had almost $50,000 coming back to them this past year that, just because of the tax reform, they have cash coming into their pocket that they weren't expecting. And again, it's available through 2021. Once 2021 comes, you'll get all of whatever is left back. Another concept here is the temporary leave credit for offering paid family medical leave to employees. Things to consider as you're going forward, ways to get some credits or some deductions that you may not otherwise think about. This is the kind of topic I want to spend a little bit more time on. There really hasn't been a lot in the news since it happened, which is the Wayfair case. So those of you who aren't familiar with this, what this case did was South Dakota changed their sales tax nexus rules to basically put in an economic nexus. What that means is that they basically stated that if you have $100,000 of sales or 200 transactions during the year, but you're not physically located in their state, you're now subject to sales tax in their state and have to remit it to the state. This is a huge change from the past where sales tax only applied if you had physical nexus. This case was put in place in August of last year. And now there are approximately 46 or so states that have implemented or imposed an economic nexus standard. This could mean that you have your business, if it's an online retail business or is doing online retail, you could have sales tax nexus in a multitude of states that you aren't aware of. Texas is actually one of them. On October 1st, Texas actually adopted Rule 3.286, which put a $500,000 threshold on it. Now, that $500,000 threshold is not just taxable sales. If you have a business that has non-taxable sales, that $500,000 threshold comes into play. It takes into consideration both your taxable sales and your non-taxable sales and imposes that rule. What it does do, some of the other things that they implemented from a Texas perspective, is they actually, because of this new rule coming into play, they added a single tax, local tax rate, meaning that if you are subject, if you're, you have meet these requirements to file for sales tax in Texas, then you can elect to basically use a single local sales tax rate rather than applying individual local jurisdictional rates. And the interesting thing about this is they do also allow you, once you've done that, you can go back and look at it and say you look and you say, well, you know what, the local jurisdictions I'm in, they're actually lower than that tax rate. You can go back and request a refund for the difference. And what they don't do is they don't impose additional tax if you're in a higher jurisdiction. So it's beneficial in both cases from a Texas perspective. But the biggest thing that we want to talk about in here is just understanding, what you need to be aware of. And a lot of people weren't aware that all of these states kind of jumped on board. So things that you need to start to consider is a jurisdiction by jurisdiction analysis. You need to go through and look at, what are the types of sales that I'm doing? Where am I doing them? Do I have the potential of sales tax requirements in all of these jurisdictions? If you look at the South Dakota case, $100,000 in taxable sales, that's not a lot. 200 transactions, you can get there easy. And, you have to look at each jurisdiction. They didn't set what the minimum requirements were in that case. So other jurisdictions could be coming in and setting the bar lower. In In Texas's case, they actually made it higher, 500,000, but by throwing in what non-taxable sales as well, if you're not paying attention to what you're doing, you could get yourself sucked in from a tax standpoint. So you want to be asking the right questions, looking at what the options are to remediate those, and only register where you need to. I run into this all the time with clients. They think that just because they're going into a state or owning property in a state that they have to run and rush to register there. I have a client that owns a vacation home or owns his home in a single member LLC in California. Had he created and he holds it in an entity, had he created the entity in Texas and rather than in California, he wouldn't have had a filing requirement because he's not doing actual business in California. But as soon as you register to do business in California or register your entity in California, you're required to file there. And even if you don't have business, it's $800 a year. So, thinking about those types of things and knowing, there's a reason why a lot of companies register themselves in Delaware. It's to prevent themselves from getting taxed in other jurisdictions. So those are definitely things that you want to be considering. And the other thing to consider is what this implication has on income taxes. So we're all talking about sales tax right now, but this has also significant implications on the income tax side. And Texas, for example, is one of them. They are looking at, and I believe they just passed something recently that is going to apply these same economic standards to the franchise tax. And so you have to not only consider what this means from a sales tax perspective, but what could it mean from an income tax perspective in all of these states that you're not actually physically located in, but you're doing business in. And as this develops and more states come in, get on board, you're going to start to see a lot of notices coming if you haven't actually looked at it yet and gotten yourselves in line and at least looked at the jurisdiction by jurisdiction analysis of where you're doing business to see whether or not it's going to apply to you. So I wanted to really touch upon the Wayfair case and that concept to kind of see where we are. And I think that the biggest thing to point out in this is that how many states are jumping on board. And the fact that it's going to trickle into the income tax realm. The next topic I want to talk about is Section 199A deduction. I would figure that by this point, most people probably already have an idea of what this is, but I'll kind of quickly go through what it is. So this was implemented in the tax reform, and it allowed small business owners, basically, a 20% deduction off of their flow-through income on their personal return, as long as it was a qualified business. Certain specialized service businesses, such as accountants, doctors, lawyers, as long as they were under a certain threshold, would be allowed the deduction as well. But once they reached the certain threshold, they wouldn't be entitled to this deduction. They implemented some safe harbors for rental real estate to allow them to treat them as trader businesses. So getting into this, what does that mean for you, your clients, your businesses, and so on? It's reviewing the rules. In order to take this 20% deduction, if you were over the threshold and you were a qualified business, you needed to either have wages or assets, the business assets, to be able to take it. So looking back, this goes back to my comment before, is reviewing your tax returns, reviewing your businesses to see if there's ways to maximize these deductions, looking at the cost benefit, potentially putting your entity in an S corp. If you are in an S corp, maybe bumping up your salary to get the wage deduction that you wouldn't otherwise have. But you have to look at the whole picture, when you do that. What is the tax implication? When you increase your salary, you're going to increase your payroll taxes. Is it going to be beneficial on the 20% deduction of the income that's coming through? So there's lots of different things to consider when it comes to the 190A deduction. But I know a lot of our clients, a lot of small business owners that don't have a lot of other things coming through other than the business that they're running. This deduction was a huge benefit to them. A lot of them saw a lot of tax savings with regard to this deductions. Others, because this deduction removed the previous 199A deduction for the domestic production activity, they didn't see quite as much of the benefit because they already had a deduction for it that they were now losing, even though they were gaining this 20% deduction. But looking at all of it, the biggest thing I think with the 199A deduction is if you had it, going back, reviewing it, seeing what benefit you got from it, seeing what ways you can maximize it and better plan for it. And that's kind of what we're kind of getting into is looking at things from a planning perspective and looking ahead. We still have 2 months before the end of the year to kind of look into those things. The other thing that came about, and a lot of people don't think about this, is because of the changes in the tax reform to individual taxes, it really forces you to kind of go back and look at how you do your withholding and how you do your estimated taxes. They got rid of all of the exemptions, even though they increased your standard deduction. So in the past, when you filled out your withholding form, you looked at it and it asked you how many exemptions do you have. You looked at yourself, your wife, your kids, and usually that's kind of how you based your withholding on for your W-2. Well, now exemptions don't apply. You have a standard deduction, and they have changed the W-4 form for the withholding process. There's a new form, there's a new approach to it. So what I would suggest people do is to take a look, see how what their withholding is doing. You know, they can probably look back to your 2018 return. I know a lot of our clients, they added a section on the form this past year for the exemption out of the underestimated penalty related to the tax reform because of this issue, where when the laws changed, people really couldn't determine what their withholding should be. A lot of people already had their exemption set up and didn't go through and change it, so it may have come down to the end of the year where your withholding didn't cover what your tax liability was going to be. So we always recommend people reviewing their prior year return, reviewing what's going on a quarterly basis to see where they're at from estimated taxes to make sure they're either withholding enough or paying enough in. You know, this could mean looking at significant income events. We're always talking to our clients and explaining to them, what the safe harbors are. If you expect your income to be consistent from one year to the next, you can always apply the safe harbor, which is 110% or 100% of the prior year's tax liability. And if you spread that out over 4 quarters, that will cover it. But if you have a significant event, income event, and you're not sure whether or not you're going to make sure that you have that cash when the tax is due, well, then you need to be made aware of that. And it may mean making withholding payments or making estimated payments ahead of time. So to prevent these unnecessary underestimated penalties, which they're not really significant, they're usually about their interest charges. So depending on how much the liability is, depends on how much it is. But they're always good things to consider when you're thinking about coming down towards the end of the year. I wanted to put up here for everyone the 2019 brackets and the standard deductions. As you can see here, it goes from 10% to 37%, and the tax brackets pretty much stayed consistent with last year, and the standard deductions as well. They're pretty much consistent with where they were last year, so that you can see kind of where it is. So again, knowing where you're at and where where you're going, you can pretty much see once you hit a certain bracket, any dollar over that's going to be taxed at that new rate, so it helps you to plan. What to expect from itemized deductions? Again, these pretty much, after the tax reform, have pretty much stayed the same. The one change that probably doesn't impact a lot of people is the medical deduction floor increased back to the 10% from the 7.5%. Most people we see don't have enough to take that deduction anyways, but now it's even harder to take it. And just a refresher to understand state and local taxes, there's the cap on the $10,000. We saw this impact a lot of people. A lot of people have 2 homes, high property taxes, and they're only getting the $10,000 deduction. So while the rates dropped, a lot of people lost out on a lot of itemized deductions, which kind of offset it, and they pretty much ended up in the same place. So again, reviewing all of the different things that come into play here. The miscellaneous deductions, remembering that all of those investment expenses that you got in your brokerage statements no longer are deductible. Unless your tax accountant is doing proper planning, proper billing, the tax prep fees that you used to be able to take as a deduction on your itemized deductions are no longer available unless you have a Schedule C where you can justify that part of the work was spent preparing your Schedule C. And really spent towards the business aspect of things. Unreimbursed employee expenses also no longer apply because of the removal of the 2% floor. So we were running into cases where we had clients with significant investment expenses that were all gone. So some of them would come completely out of, when you put that along with the $10,000 cap on the state and local expenses, you could see people falling out of itemized deductions where in the past they had, $100,000 in itemized deductions. So it's important to review your tax return, review what had happened, and plan for that going forward. See if there's ways you can maximize your itemized deductions. Again, child dependent tax credit, those both increased. This was a big push by, I think, Marco Rubio when they were doing the tax reform. He really wanted this in there. I think President Trump's daughter was also one of the ones that was really pushing for this to help. So remembering, I think they also increased the phase out for that as well. So we had some clients in the past that weren't getting it, that got it this past year. And that's a straight credit, so it was helpful to them. So another area I'm going to spend a little bit more time on is the qualified opportunity zones. And one of the reasons for this is timing. Because we're coming up to the end of the year, the time in order to take the max benefit for this is running short. This area here was created in the tax reform to incentivize people to invest in low-income areas in order to basically bring up these areas. This allowed people that had capital gains to defer those capital gains by investing it into a qualified opportunity fund. The benefits for doing that were not only just a deferral, but if the property was held for 5 years, you got a 10% permanent reduction, or basically an increase in basis, which reduced that capital gain by 10%. If it was held for 7 years, you got an additional 5%, making the adjustment 15%. And then if you held the property for 10 years, or the investment for 10 years, anytime as long as you sold it between that point in time and 2047, you would basically, any appreciation on that property would be tax-free. So this is a change that came in that's kind of never really been put into place before, where investors could defer capital gains, save money on those capital gains, and then if their investment made them money, they didn't pay any taxes on that. But it was all done as a way to help prop up these economically distressed areas. Now, the reason why we really want to bring this up, and again, I'm only highly brushing over kind of this area. If you want more information, we can talk about it afterwards. But the reason that I'm trying to bring it up now in a tax planning discussion is that, as I pointed out, the permanent exclusion of this gain, if invested, is 7 years. Well, by 2026, all gains have to be recognized. That means that in order to maximize that 15% benefit, the investment needs to be made before the end of the year. Otherwise, you only can be entitled to you'll still be entitled to the 10% and the 100%, but you'll miss out on the 5%. So what I expect to see and potentially see is you're going to see a lot of people, looking at what their capital gains are, looking to see what these investments are, the opportunities that they have, and see what they can do to maximize their benefit. Getting a little bit into it, so I mentioned a qualified opportunity fund. What that is simply an entity that's either a partnership, an S-corp, that's used, it self-certifies itself, meaning that it designates itself on a form filed with the IRS that it is a qualified opportunity zone fund. In order to meet those qualifications, it merely needs to own qualified opportunity zone property, and it has to own 90% of its assets in qualified opportunity zone property. What qualified opportunity zone property can be is it could be a partnership interest, it could be S-corp stock, C-corp stock, or it could be the physical assets. Owning a building in an opportunity zone would qualify. Now, the partnership interest in the S-corp stock, that would need to be qualified opportunity zone business property, meaning that it has to be running a business within a qualified opportunity zone to meet the qualifications. And again, I'm not going to try and get into the full level of details. I'm just kind of trying to touch on the high level topics here, because this is a topic in itself that could take hours to go through and the intricate levels of detail. But what I really wanted to get into is understanding that understanding the regs, understanding what's going on are important if you're getting into these types of ventures. Understanding that your structuring is done properly, understanding that, you know what, I'm going to meet these qualifications, because if you don't meet the qualifications of the Opportunity Zone Fund, you can subject yourself to penalties. For every month that you don't meet the qualifications, you don't hold the right assets in the property, you haven't structured it properly. But the benefits, when it comes down to this, could be significant. From my understanding, right now they have 2 sets of proposed regs out. One came out right around this time of last year, and then another one came out right around the end of April of this year. There was the expectations that there were going to be more proposed regs, but the last I checked, what they were planning on doing was actually just combining the 2 regs together into one and kind of mirroring it. And there are, out there you can actually see, I think some of the different research tools have kind of done an overlay of the 2 proposed regs, so you can see what was originally proposed, where things have changed, and what was added, what was taken out. Things that we've run into when we've been dealing with this is the related party rules, making sure that you couldn't have owned the asset prior to the rules coming into effect and then sold it to yourself to get it to qualify. Those rules kind of were put in place. Lots of other rules. So what I would say is if you're more interested in this, this is an area where we'd be happy to sit down with you, kind of talk you through it, see where there may be opportunities if you have any, to kind of get into it, explain the rules a little bit further, and see where the opportunities are. But if you are going to get into it, you got to know what you're doing and who you're doing it with. And that's where we get into talking about you have to understand these rules, because it's layer upon layer upon layer of how these things work and how you can structure things. We've done a few different projects with different clients. I had a client in Winsboro already owned assets that were in an Opportunity Zone. We worked with him to help him structure his entities so that we could get everything to qualify. We worked with different planning strategies to get things moved into different entities and get everything set up so that he now has qualified. The other thing that you need to consider is that, again, know what you're doing. You have to have capital gains. Otherwise, there's no benefits that you get from this other than owning these investments. So if you don't have the capital gains to invest, there's really not much you can do. So proper structuring, reviewing fund options, including the people that you're doing with it. A lot of what you're going to see is real estate developers trying to jump into this, and they're just trying to get on the bandwagon of let's try and make money, and they may not necessarily have all their ducks in a row, and the project itself may not make sense. So you have to make sure that if you're going to get in bed with any of these people that are doing these projects, that you've vetted it, that you understand that it's going to work from a business perspective first, and then make sure that it works from a tax perspective. Don't let tax wag the tail in this case, even though the benefits do seem to be really, really beneficial. The other thing that I would say on this is you also have to remember that you need to hold the property, the investment, for 10 years. That's a long time to reinvest these capital gains, and a lot of people aren't really looking for those. So you have to know when you're getting into it that this is a long-term investment, that you have to hold it to those 10 years. Otherwise, you'll still get the other benefits for the 5 and 7, but you do need to hold it for the 10 years. So that's kind of the rundown on Opportunity Zones. Again, this comes from a tax planning, is that we have until the end of the year. You can look back, see if you have capital gains, see if the business entities have capital gains where you may be able to take advantage of this. And then once you know that, well, then it's going out and finding the opportunities if there are any that are out there. Again, from a year-end planning, we like to talk about the retirement considerations. These basically kind of walk through the ages and what occurs at each of the age. Most of this stuff hasn't changed. Talking about catch-up contributions to IRAs, distributions from 401ks, distributions from IRAs without the 10% penalty, various things, RMDs when you have to take those. The 529 plan contributions for basically providing for your, dependents or an individual's student tuition hasn't changed. It's the same, $15,000 a year, or you can do a $75,000 5-year gift election for that. And again, we just want you to make sure that everybody's aware of these, making sure they're understanding what goes on as they hit different age requirements, and reviewing the distributions of withholding elections to prevent underpayments. This last one's a big thing that people don't realize they can do, is that when you have that required minimum distribution, you may not have been paying the taxes throughout the year when that distribution hits. But what you can do is, if you work with your brokerage firm or whoever's holding those IRAs or retirements, you can make a withholding payment on that distribution as it's made to cover your taxes for the full year. And because of the rules on withholding taxes, a withholding tax payment is actually deemed to have been made throughout the year, not necessarily just on the day that it happened. And it can help you prevent underestimated tax penalties. Some updates in planning for estate and gift tax. Again, I think there was maybe a small increase to the exemption. It's at $11.4 million for 2019. The annual exclusion for gift tax is still $15,000. And again, that's per person, per family. So, per person. So if you're a husband and wife, you can each give $15,000 to your child, and that counts towards it. Things we talk to our clients about is, if you want to give more, look at the family in its entirety, gifting to the children as well as the parents, to maximize that $15,000 exemption. People don't realize that because it's $15,000 a person, if I have a relative that is husband and wife with 2 kids, well, that's 4 different people I can give gifts to. And as long as it's done in the proper way, you can still work with that and getting the $15,000 per person. Some other things: paying medical or tuition expenses directly to the provider to avoid the lifetime gift exemption, and reviewing and updating legacy documents. There's a lot of times people don't pay attention to their retirement, to their estate planning. I had a client owned a $100 million business and doesn't have a retirement plan or an estate plan at all. We've talked to him multiple times about doing it, never did it. We kind of walked him through and said, listen, if you die tomorrow, your estate owes like $70 million in taxes. And that means you got to sell the business in order to cover it, and that leaves a lot less for your inheritance. So definitely things you want to look at, ahead of time. Don't, and I hate to say it, but anybody could walk down the street and get hit by a bus. You just don't know. So thinking about this ahead of time is always an important thing to do, just to make sure everybody's covered. Other things to think about in this, other ways of giving, basically charitable gifting, is creating different things such as private foundations, donor-advised funds, charitable. These allow you to potentially you give a large deduction up front, but not necessarily determine who it's going to go to till later on. We've dealt with a variety of people in our industry that handle these things, can get these things set up for you. When you want to start to heavily gift, these are ways of doing it without having to say, oh, I'm going to give it to this charity right now and this charity right now. You can basically get the deduction up front for a large amount and then spread that gift out over time. And then with that higher gift, that higher exemption right now, this is if you're older in years, this may be a good time to start planning on shifting the business to family members, utilizing that high gift tax exemption to allow you to be able to shift business ownership without having to wait until later on. I wanted to bring this up again. This is just briefly because earlier in the year they were talking about the tax extenders. What these are all of those sunsetting provisions or provisions that have expired where the government has to step in and basically vote to extend them, make them applicable going forward. One of the common ones in the past used to be the bonus depreciation that used to expire every year, and they have to come in and extend it in order for it to qualify. That has been made permanent now, but here are just a list of some of the other ones. Highly unlikely that the government's going to get to it anytime soon with everything that's going on, but these are the things that are kind of out there to consider. And then I wanted to go through kind of an election year. I think last time we went through this, I think it was a little bit more certain who was going to be the running people. I think this time around, on the Democrat side, there's, I don't know, 10, 15, 20 people running, and nobody knows who's going to win. And there's a variety of different proposals that people are talking, from your health care for all to, a variety of different things. But we kind of wanted to run through some things to consider, thinking about just in case as things go along, if they do win. Things that they've been talking about, lowering taxes for the middle class. From the understanding is that most Democrats, I think, still believe that the tax rate should have been lowered from 35% for corporations, but most of them believe 21% was too low. So they think about that's a potential that it could get back increased again. So they think that the individual rate could go back up on the top bracket to 39.6. Variety of different things just to consider, over the next year as you're thinking about it. Again, this talks about looking past 2019 into 2020, all the different things that could come about in this next election, depending on what happens. Other considerations we wanted to talk about, just a reminder that the health insurance mandate for individuals has been repealed, meaning that there's no more penalties for individuals that don't have health insurance. But the mandate for employers has not. You still have the requirement that were in place before of making sure that people have insurance or are offered insurance, and the filing requirements that go on with that. So just because the individual mandate's been repealed, make sure that you remember that the business employers has not. Some other things, going back to the 2020, there's been some wealth tax proposals. I think Elizabeth Warren is one of them that has proposed basically a tax on wealthy individuals that have assets of over $50 million. Things to consider, to look at as things go forward. The tax implications of cryptocurrency. It's become a huge topic lately. All the implications that has. Understand it. Look into it if you have those types of issues. Cannabis businesses has become a hot topic. People don't realize what those businesses entail. I've had clients that come to me and asked about getting involved in cannabis businesses, and you have to understand that there's legislation out there because cannabis is still a restricted substance, that you're actually not allowed to take ordinary business deductions against that business income. So you have to understand that if you're getting into that business, that you can only take cost of goods sold. You're not allowed your general sales deductions and all that kind of stuff in that business. So a lot of those businesses are highly taxable businesses because of that. A lot of deductions they can't take. And there's proposed legislation regarding, and that's Section 280E is what talks about that. But for right now, I don't think there's any moves to make that any different. And then I also want just other considerations. One thing we always talk to our clients about is remember that if you're going to gift a non-cash item that's large, over $5,000, remember that you're going to need an appraisal for that. It's difficult when it comes to tax return time, and we get a client that gives us documentation that, I think we had one last year, we gifted a $10,000 rug, and we're like, well, you need an appraisal for this, and you need documentation from who you gave it to and all that kind of stuff, and it gets hard to track that stuff down after the fact. So it's just things to consider if you're doing during the year. That's pretty much kind of the topics that I wanted to address. If you have any questions or comments, we're willing to take them now. Yeah?
Go back to your interest limitations on your asset, on your businesses, and also if you can't deduct it, why wouldn't you capitalize it for either depreciation purposes or keep track of it, especially if you have an asset or real estate? Why would you keep track of it for Section 111 purposes for the no tax benefit rule when you sell?
Well, the interest limitation it basically is a NOL. Basically what happens is you're still allowed to deduct it. It's just you have to have income in the, it carries over, yes. Carries over from year to year. So, and it's related to interest, it's an interest expense. So it's not really tied to any asset.
Well, I'm talking about if you bought a piece of equipment or property with it, especially real estate.
Yeah.
Because if you've got a client that has not only his personal residence, but also other assets like his vacation homes, he can't deduct the taxes, he can't deduct the interest, the whole bit. He just capitalizes it or invoke section 111 when he sells it.
Oh, well, and those are considerations, but the fact that it's carrying over, I would assume that any gain that occurs at the time
But
of
not
this.
the interest and taxes on his Schedule A.
Well, this is a business
Yeah.
entity concept, not an individual. So on it's on a business side, and remember that you're talking about a business that has $25 million in gross receipts. So it's a much larger concept, business concept. So I don't think it's necessarily going to come into play quite in that context. But, yes.
For purposes of the aggregation rule for the 25 million,
Mhm.
is there a minimum ownership, common ownership?
There is, I don't remember it off the top of my head. I think it's somewhere around, I want to say it's 50, I actually think it's 50%.
50%?
Yes, it is actually, because we dealt with this in my client, because I have a client that owns partnerships where they control them and partnerships that they don't. And the partnerships that are controlled, we had to file the proper forms. So yeah, it's a 50%, greater than 50% rule.
Okay, greater than.
Yeah.
Thank you.
Anything else?
Thank you for coming, we appreciate it. If you have your CPE forms, make sure to turn them in. If you're not on our regular recurring list, please leave a card out front. The ladies will make sure to get you on the list so that you're invited to future events. We'll keep you updated. It's what we're going to do in 2020 in terms of when we start back up in the spring. If you have any suggestions on topics, ideas, and stuff, we're always interested in hearing. Thanks again. Be careful out there. It's slick.